One of the biggest lies out there about passive income is that you need a ton of money to start generating passive income. Yeah, the more money you have, the more passive income that you can generate, but you don't need a ton of money to start generating passive income. And in this video, I'm going to be going over how you can start generating $100 a month in passive income. What's up everybody, I am Jaspreet Singh from the MinorityMindset.com, where money minds rethink rich. The ultimate sign of wealth is when you don't got to go to work and you have enough money coming in to cover your regular expenses so you can live your life and do whatever you want and not worry about the price because you got this passive income coming in. Now, most of us are not born with rich parents or have millions of dollars just fall into our laps, so earning that type of passive income takes a lot of time. But that doesn't mean you have to wait to start generating this passive income. Actually, one of the best ways to keep growing your passive income is to consistently making small investments. That way, every single month, you can see your passive income grow by a little bit. I mean, even if you can grow your passive income by just $10 a month or $5 a month or even $3 a month, after a few years, now we're talking about some serious money. So let's jump right into it. Let's go over the 5 different things that you can start doing today to get that $100 a month in passive income. Now, before I get into these 5 things, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. The first way you can start generating $100 a month in passive income is just by investing in companies that pay out regular cash dividends. One of the most frustrating things about the whole idea of passive income for me is when you're on the internet and you see these people selling these courses on how to generate passive income by starting this internet business. And it is so frustrating because starting a business is nowhere passive. Okay, I'm telling you this from experience. It is not passive or easy to start a business, especially to build a sustainable business that's going to produce you recurring revenues month after month after month. Building a business is hard work. It takes a lot of time and it takes a lot of work. And if you are not willing to put in that work, then your business is going to go nowhere. I don't care what that person on the internet is saying. The alternative to putting in all the years of work to build a business which pays you with passive income is just to invest your money into an already established business that will already be willing to pay you with passive income because you're one of the owners of that company. One of the easiest and most successful ways to do that is by investing your money into a company on the stock market that pays out dividends. So stocks are companies that trade on the stock market, and when you go out and you buy one share in a company like McDonald's, you become one of the owners of the McDonald's company. Now, you don't got to go out and flip burgers, and you don't get to tell McDonald's what to do with their business with that small of ownership, but you get to share in some of the profits when McDonald's makes a lot of money. The thing that you have to understand about dividends is when a company has a whole bunch of cash in their bank account at the end of the year, there's 3 things that they can do with this extra cash. They can save it for an emergency. They can reinvest this money back into the company to grow bigger and open new franchises and open new offices. Or they can reward you, the shareholder, by just giving you a check. The thing that I want you to understand about this is you got to understand what stage a company is going to be in before they take all this cash and just give it away to their investors. Because if a company is smaller and they're trying to grow quickly and they have this extra cash in their bank account, they're not just going to want to give it away. They're going to say, we want to take this extra cash and reinvest it in our company. That way we can grow quickly. But when a company is very large and established and they don't have better use for that money because they're like, we don't have a place to invest this money, that's when they're going to take this extra cash and they're just going to give it away to their investors. And one of the ways to give it away is through dividends. And this is literally just a cash payment that you will get for owning the right companies. So not every company is going to pay a dividend. This is going to be mainly your larger, more established companies. And so your smaller, more kind of startup companies are not going to be paying dividends because anytime they have extra cash, they're going to want to take all this extra cash and reinvest it back into their business. That way they can grow bigger. I broke down the dividends for a few different companies. That way you can see what it would look like at the time of me recording this video. So McDonald's MCD is paying out currently a 2.4% yield, Coca-Cola 3.3%, Verizon 4.5%, and AT&T 7.2%. What this means is if you deposit $100 into McDonald's today, over the next year, they will pay you $2.40. Coca-Cola would pay you $3.30, Verizon would pay you $4.50, and AT&T would pay you $7.20. So if you just make a $100 one-time deposit or investment into these companies, you're not going to make a huge dividend, which is why you got to keep consistently investing. And the thing that you got to understand here is that this dividend is a way for you to get paid without you having to actually sell your stock, because when most people invest their money in the stock market, they're looking to make money when the stock price goes up. So if you buy a stock for for $100 a share and it goes up to $200 a share, you made $100, but you don't actually make that $100 until you sell your stock. And then once you sell your stock, then you don't own the stock anymore and you just have the $200 in your bank. Over here, it's a little bit different because now your goal is both stock price appreciation, so you want to see your stock price go up, and you also get these dividends. So when you invest in McDonald's or Coca-Cola or Verizon or AT&T, you're investing your money hopefully into this company because you believe in this company and you believe they're gonna make more money over time. So you're hoping that the stock price will go up. But in addition to that, you're also getting this passive income dividends, just kind of like as icing on the cake. And these dividends that you're getting is completely passive income because you don't have to do anything to earn this money, and you get this money without having to actually sell your stock. So this is a way for you to generate passive income on your money without having to ever sell your assets. When these stocks pay out a dividend, or when most stocks pay out a dividend, they pay out these dividends, these cash payments every quarter, meaning every 3 months. And so if you want to make $100 a month, which is $1,200 a year in passive income, to do that based off of these returns, based off of today's returns, that means you would have to put in $50,000 into the McDonald's stock. With Coca-Cola, you'd have to put in $36,000 at the 3.3% dividend yield, or $27,000 into Verizon, or $17,000 into AT&T, if you want to generate that $1,200 a year in passive income. Now, this might sound like a lot of money, which it is, but again, this is not something that you're probably just going to do today. These are things that you have to build up over time by consistently investing your money into these dividend-paying stocks or into these dividend-paying things month after month after month if you want to generate a consistent and growing passive income. But there's one more thing that I want you to understand about this, because these dividend yields don't just stay the same. And this is in addition to the stock price appreciation. So your goal, again, is to see the stock price go up, but this dividend yield can go up as well. Because if these companies make more money and they have a lot of extra cash sitting in their bank account at the end of the year, then the more cash they have, the more money that they'll be able to pay out in dividends. And so if McDonald's next year realizes that they have even more cash sitting in their bank account because they were able to grow very quickly and they were able to sell a whole bunch of their burgers and fries, so they have a big profit in their bank account sitting there, well, now they will be able to pay you, the shareholder, a bigger dividend. And so because you own these shares, now you're going to get a bigger dividend check just because the company that you invested in was a good company and they made you more money. Now, before I go on to number 2, if you do want to learn more about how to invest your money in stocks and how to passively invest your money into these things, that way you can grow your passive income, our team broke this down on our website, theminority-mindset.com, and an amazing article that breaks down how to do it. And they even have brokerages that they recommend that can help you invest your money passively for free. So if you want to learn more about how to do that, I have the article for you in the description below. The second way you can invest your money for passive income to generate $100 a month passively is by investing your money in REITs, which stands for a real estate investment trust. So REITs are kind of like Wall Street's favorite way to generate passive income because they give you exposure to real estate rental income without having to physically manage real estate or own real estate. The way REITs work is you are investing in a company which invests in real estate. And so you're not getting direct exposure to the real estate itself, you're investing in the company that invests in real estate. And the reason Wall Street likes REITs for passive income is because REITs are required by law to pay out 90% of their taxable income, so their profits, which is through rent, to their shareholders, people like you, through dividends. And so if you own shares in a REIT, chances are you're going to see higher dividends because these companies are required to pay out the majority of their profits to their shareholders in dividends. Now, there's a couple of different types of REITs. You have mortgage REITs and equity REITs. Mortgage REITs are REITs that invest in actual loans and mortgages, versus equity REITs are REITs that invest in physical properties. These property REITs, equity REITs, they make money through rental income. The mortgage REITs make money through interest when people pay mortgages on their properties. For you, it doesn't really make too much of a difference because in either case, you're just investing in a company and you're hoping to get dividends, but it's something to be aware of as you're researching the company. So I'll give you an example. NLY is Annaly Capital Management. This is a mortgage REIT. So this is a company that invests in mortgages and they're paying out an annual dividend of 10.4% a year at the time of recording this video. Simon Property Group, on the other hand, is an equity REIT, and this REIT invests in physical real estate and they're paying out an annual dividend of 5.2% a year. Now, these are just examples. Everything that I'm telling you today are just examples. Make sure you do your own due diligence and never blindly listen to a random guy on YouTube because investing has risks. You are never guaranteed to make money you invest, and you might even lose money, so make sure you always do your own due diligence. Now, based off of these current dividend yields, if if your goal is to make $100 a month or $1,200 a year in passive income, that means you'd have to invest $12,000 at this 10.4% annual return to get your $1,200, or here, $23,000. So the dollar figure is a little bit more accessible than what I talked about just a minute ago, but there's a word of caution that I want to give you when it comes to investing in companies or really anything that pays out a higher passive income or dividend yield. You should never make your investment decisions based solely off of what this dividend yield is, because this dividend yield can be misleading. Like if a stock price is tanking because the company is about to go under and they haven't gotten rid of their dividend, then their dividend yield is going to look abnormally high because they're paying out a huge dividend based off of what their current share price is. But what the dividend yield is not telling you is that this company is on the verge of bankruptcy. So if you invest in this company just because you want the high dividend and then this company goes bankrupt, then yeah, maybe you got a really nice dividend payment one time, but after that, the company is no longer there. So it wasn't really worth the investment. This is a mistake that I made back when I was in college, because I saw that some of these REITs at the time were paying 15, 18% dividend yields a year. And so I was like, wow, these are amazing returns. And even if the stock price goes down a little bit, who cares? I'm getting these huge dividends. And so I started investing my money into these REITs. But what I didn't realize was a lot of times with these REITs, especially these high dividend REITs, is when it comes time for them to pay their dividend, what you'll see happen is their stock price will go down by this dividend amount. So if a company is paying out 10% a year in dividends, then what you'll see happen is when they pay out their dividend on that date, you'll see the stock price go down by the amount of dividends that they paid. And so when it comes to investing in these REITs, you really got to dive a little bit deeper and look beyond just this dividend yield, and you want to look at the underlying fundamentals of a company, because here you might be really attracted to the dividend yields, but if you don't like what this company is doing or what industry this company is investing in, then it may not be something worth kind of just getting that short-term high dividend, because if the stock price goes down more than the dividend, then you're paying the price. The third way that you can invest your money for passive income and generate the $100 a month is by investing your money into a high dividend ETF. Here's the thing, the majority of people probably should not be in the stock picking game, because either they don't want to do all the research and work involved to actually study and find a good company, or they cannot handle the emotions of actually investing in a company, because sometimes things will go wrong and their company will go down and they cannot handle seeing their money in the red. And so when that happens, they panic sell. An alternative to finding the best company to invest in and investing in individual companies is investing in an ETF, which stands for an exchange traded fund. Now, when you invest in an ETF, you are investing in a fund which gives you exposure to a whole bunch of stocks, because now you're not trying to find the perfect company, you're just investing in an ETF which gives you exposure to a certain group of stocks. One kind of category of ETFs are high dividend yield ETFs, and these are funds that invest in high dividend paying companies. That way now you don't have to worry about investing in one company and trying to get this dividend and worrying about this company going bankrupt or this company failing. Now you're investing in a fund which is trying to find you the best high yield dividend companies, and hopefully you're going to see the value of this fund go up, so you're going to see your stock price go up, hopefully. And in addition to that, you're trying to get these high dividend yields. That way you're getting the passive income on top of the stock price appreciation. So a couple examples of this are SDIV and VYM. This is a Vanguard fund. This is not, but these two ETFs are dividend funds which invest in high dividend paying companies. VNQ is a REIT ETF. This is another one by Vanguard. If you're unfamiliar with what Vanguard is and how ETFs really work, I already made a video where I explained all of that. And if you want to learn more about that, I'll link it for you in the description below. But this is an ETF that invests in a bunch of different REITs. So if you want to get exposure to the real estate market and get your rental income from that, because that's what you believe in, then VNQ is a way for you to go. Again, these are all just examples. I'm not telling you what to invest in, just trying to get you ideas of how it works. If you want to get to the $100 a month in passive income, which is $1,200 a year, again, most of these funds are paying quarterly, but if you want to get it, you got to be investing $15,000 at this 7.9% yield, $37,500 at this 3.2% yield, or $30,000 at this 4% yield. Remember, do not make your investment decisions solely off of this. Look at the underlying fundamentals. This is your icing of passive income on top. And again, this doesn't mean that you have to have $15,000 or $30,000 right now to go and invest this money in order to start getting these yields. The best thing you can do is not just make a one-time investment. Just every time you get paid, you put a little bit of your paycheck, 15% of your paycheck every time into whatever funds or ETFs or stocks that you want. That way every single month you have some money going towards your investments. That way over the years you are building this nest egg that is a machine that is producing you income, especially if you're investing in these dividend funds. So the first three examples I gave you are completely passive. You just find a stock or ETF that you like, and then every time you get paid, you just put some of your money into these funds, and this happens passively. I have an article explaining how to do that in the description, but this happens passively, and now you're building this machine that's generating you passive income, and you don't got to do anything else. Number 4 is a little bit different. Number 4 is get this passive income through real estate. So real estate is my personal favorite place to invest my money, because when I invest in real estate, I have something tangible and physical that I can see, feel, and touch. Because when you invest your money into McDonald's, the stock, you don't own something physical. Like, you own paper shares of the McDonald's company, and you don't get to really tell McDonald's what to do. And so if their executives drive the company into the ground, I'm the one paying the price. But versus my real estate, now I own this property and I can control it, and I know how we manage it, and I get to do the research on where this property is going to be, so I get to have more control. And so for me personally, I like that. That's not for everybody. The thing that you have to understand about investing your money in real estate is, in the beginning, it is not going to be passive. Because you have to jump over this hurdle where you got to go through the learning curve, you got to meet the people, you got to find your team members, you got to know who the real estate attorneys are, you got to know who the real estate agents are, you got to find the contractors, you got to find the property managers. But once you own a property and you get it streamlined, after that it is completely passive. Like now with my investment properties, all I do is every month I spend maybe an hour reviewing the reports that my property management company sends me, and that's it. The way real estate investing works is you're going to go out and you're going to buy a property. Let's say you buy a house. Once you own this house, you're not going to be the one living there. Instead, you're going to have a tenant, let's say a family. They're going to move into this house, and every single month they're going to pay you rent for living in your property. Now, the goal is that this rent is going to cover your costs, your mortgage costs if you have one, your taxes, your insurance, your maintenance, your management fees, and everything else, and then put a little bit of money into your pocket every single month. That way you have a property that's paying for itself and that's making you money passively. That way now you can go out, you can go to your job, or you can go on the beach in Hawaii, and you still have this rental income coming in because somebody's living in your property. The thing that makes real estate investing very unique is when I invest my money in real estate, I make all of my investment decisions based off of one thing: passive income. How much money do I have to invest today, and how much passive income is this property going to pay me every single month after that? So when I make my investment decisions, I am looking for a minimum 7% passive income, kind of cash on cash return. So for every dollar I invest today, I want to see 7 cents come back into my pocket in passive income. I'm not looking at the future appreciation. If the property value goes up, that's icing on the cake. If property values go down, oh well, at least I'm getting the 7% a year in passive income. And so now, if your goal is to get $100 a month in passive income, this is $100 net of all expenses, so property taxes, insurance, maintenance, management, and you got to make sure that you're hitting this return, whatever your investment goal is. This is going to vary on your area, while keeping this $100 in your pocket. So if we just do the math, that means you would have to invest and buy a $17,000-ish property in order to make $100 a month passively. Now this is where things are a little bit tricky, because chances are you're not going to find a property for $17,000, especially in this market. This is what makes real estate a little bit more difficult than investing in the stock market, because in the stock market, you can start investing with as little as $100. And if you don't have the money to buy one full share of a company, you can invest in a fractional share. You can't really do that when we're talking about physical real estate, because you got to be able to buy the entire property. You can't just buy 1/4 of a property, at least not in traditional ways. And so this is more difficult, because now you're not going to be able to buy a property with $17,000, at least not a traditional regular property that we're talking about. And so if you want to be able to invest in real estate, you need more capital, but you can kind of follow this rule. But even this rule, when it comes to how much of a return you want, this is going to depend on which area you're investing in, because some areas like your New York and your San Francisco, these are going to have much lower returns because these are bigger cities and lower risk areas, and so you're going to have to pay the price by getting a lower return. If you're in the Midwest, these are more kind of like your better cash flow producing areas, and so you can see the 7% return pretty commonly. But once you buy a property and you own it, you can hand over the keys to a property management company, and their job is to make this property and this investment completely passive for you. That way you don't have to do any work, and this money that you're making will be coming in every month, because as long as they have a tenant living there, they got to pay you every month for that. Now I should also mention that there are alternatives to owning physical real estate. Like obviously you can invest in REITs like I talked about, or you can invest in funds that give you exposure to physical real estate properties. This is things like crowdfunded real estate, where now you're not actually buying the entire property, you're getting exposure to a small piece of a property so you can invest a much smaller amount. So now when you do that, you're not buying the entire property yourself, you're investing in a fund, not on the stock market, but through this crowdfunded fund, which gives you exposure to the property. I'm not going to go over that in this video, but I'll link some resources for you in the description below. So the first 4 ways I've talked about of these passive income ideas all revolve around you investing your money into this thing, and then this thing is a machine that will now produce you passive income. Number 5 is a little bit different. Instead of you just investing your money, I'm going to have you invest some time right now, which will generate you passive income for years, hopefully into the future. Number 5 is creating digital content, which I call pseudo passive income. The whole idea behind this is you're going to create content for the internet. Maybe this is a blog post, maybe this is a podcast, maybe this is a YouTube channel. How you doing? Or maybe this is an Instagram page where now you're putting out content and your goal is to attract an audience to your content. And when people see and read and hear your content, you can market certain products to them, and anytime they buy your content, you get paid. The great thing about this is not like running a physical store where somebody's got to be standing there greeting them and actually checking them out. Now this is all done digitally. And once you put out the content once, people can see that content you created today, 2, 3, 4, 5 years into the future. So now the way this works is you're going to start creating digital content. So this is your blog, your podcast, your YouTube, whatever it is. And within this content, you are going to market a product. And this doesn't have to be a product that you create. You can do something called affiliate marketing, where you partner with someone else's product, and anytime somebody buys that product from your content, you get paid. So in your content, you're going to market this product, whether it's your product or someone else's product. And then when they click on that link from your product, they're going to go to a product page, or this could be the checkout page. So let's say you're talking about a fitness blog. This might be a protein supplement. They go check out the protein supplement, and if they like it, they're going to go to the checkout page. Now, for the purposes of this example, let's assume that anytime somebody comes here and they make a sale, you walk away with $10. The thing that you have to understand here is everybody that reads your blog is not going to go to the checkout page. Like, not everybody that reads this blog is going to actually click on that protein supplement, and everybody who comes on this product page is not going to actually buy it. So you gotta have to work backwards now. So if your goal is to make $100 a month passively, that means you're gonna have to make 10 sales every single month, because you're making $10 a sale. So that means you're gonna have to have 10 people every single month hit the sales page. Now the goal is obviously to grow this, but let's start with the $100 a month example. So you want 10 people every month to hit the sales page. Now a good conversion rate from your product page to your checkout page is 3%. So that means you need about 330 people to come onto this checkout page or this product page in order to convert 3% of them and get 10 sales every single month. But if you need 330 people to come here, you need even more people to come to your blog and actually click this link. So a good conversion rate here will be something like 10% of people reading your product or seeing your product and then clicking whatever the product it is you're offering. So if 10% of your audience reads your content or sees your content and goes to your product page, that means that you need right around 3,300 people checking out this piece of content every single month to get 330 people to this checkout page to get 10 sales at $10, which will make you $100 a month. Now, these conversion rates are going to change depending on what your content is, how good your content is, how good this product is, and how expensive and what the product is, but it gives you kind of a general framework. If your goal is to make $100 a month in passive income, you can kind of just do this reverse engineering based off of how expensive this product is and how many people you need to go onto your content every single month. Now, in the beginning, this is going to be very hard because no one's going to be seeing your content. But if you consistently keep putting out content, then eventually, if people like your content, they're going to start coming. And if you can kind of build this consistent stream of traffic to your website or to whatever your content is, then you just follow this funnel. And the great thing is now, as you continue to produce new content, your old content that you produced a year ago is still generating you this income. So you're building kind of these like passive income revenue streams, but in order to grow it, you got to keep putting out more content. That's why I call it pseudo passive income, because your previous content that you've already created is now passive because you created it once and now it's generating you income. But if you want to grow your past passive income, then you got to keep putting out more content today. To succeed in this game, it takes a lot of consistency and a lot of dedication. This is where a lot of people come out and they say things like, here, just follow these 6 steps to build this $1,000 a month passive income business. doesn't work like that. It takes a lot of time and a lot of effort, but if you can consistently do this and you stay diligent, you can hit the $100 in pseudo passive income in 6 months. Some people can do it faster and some people are going to take longer, but the whole idea is you're going to put in all this work in the beginning. That way you can build this kind of income stream where now you're making a disproportionate amount of money compared to how much work you're putting in today because of all the past content and the work that you put in, which is now generating you more pseudo passive income. If you enjoyed this video, here's the video on how you can start generating passive income with $1,000 that I think you'll love. And while you're at it, join our free finance and business newsletter. And as always, keep hustling. You have to deal with tenants. If you're investing in real estate, you're gonna have tenants that slip and fall while they're taking a shower, and then they're gonna sue you because they will say that the bathtub was too slippery when it was wet.